President Trump's sweeping 10% import tariff sent shockwaves through Detroit and, well, unexpectedly catapulted Toyota to the top of the U.S. auto market. What looked like a blow to Japanese automakers quickly flipped into a strategic win. Within just 5 months, sales data and profit margins revealed a surprising twist. At the center of it all, Toyota's complex, multi-layered global supply network, and the pricing shock that forced Detroit automakers to raise sticker prices sharply. So what was the pivotal move that flipped expectations on their head? We're breaking down the numbers, the global ripple effects, and why the Japanese giant came out on top. But first, don't forget to hit subscribe, turn on notifications, and give us a like to keep up with our latest videos. At first glance, President Donald Trump's universal 10% tariff on imports looked like a setback for Toyota. The administration rolled out the policy with slogans like, "We'll sell American cars on American soil," earning loud cheers across Michigan. But the first half of 2025 told a different story. But the story goes deeper. Tier 2 suppliers in Michigan and Ohio faced steep cuts in steel and aluminum orders from GM and Ford. Toyota's Alabama and Kentucky operations, using different materials and supply chains, weren't affected. As a result, small manufacturers across 18 states saw order volumes drop by as much as 20%. Meanwhile, Toyota's Huntsville engine plant scaled production to replace aluminum blocks previously sourced from Kobe Steel's Alabama unit. These were exempt from tariffs thanks to a special casting loan from the Trump administration. As a result, the U.S. supplier ecosystem split into Toyota integrated versus Detroit dependent. Consumers felt the crunch too. Interest rates held at 6% by the Fed pushed the average 4-year auto loan cost to 11% annually. Bank of America reported Toyota buyers owed $600 less at loan maturity and defaulted at half the rate of rivals. Toyota Financial Services raised its loan APR modestly from 0.99% to 2%. Ford Credit, by comparison, jumped from 3.75% to 4.5%. This spiked delinquency to 3.4% at Ford, the highest post-pandemic, versus just 1.8% at Toyota. Different approaches to raw material risk made the gap wider. Toyota locked in battery cathode supplies via a 3-nation corridor, Australia, Canada, and the U.S. Meanwhile, GM and Ford leaned on Canadian and Indonesian nickel under Biden's IRA incentives. But looming Trump-era aluminum taxes could wreck those cost calculations. Toyota is gradually switching from lithium iron phosphate to nickel manganese cobalt batteries and building in aluminum cathodes sourced locally, dodging tariffs. Then came the Forex factor. As the yen dropped to 150 per dollar in late 2024, Toyota cashed in on currency arbitrage. Profits from Japan poured into U.S. investments. Meanwhile, Ford lost ground in Europe and GM's first quarter 2025 cash reserves fell to $22 billion. Toyota's climbed to $45 billion. Wider trade trends tell the same story. The U.S. auto trade deficit, including vehicles and parts, hit $84 billion by May 2025, up $11 billion year over year. The tariff slowed imports but also hurt exports. In short, Trump's protectionist hopes backfired, at least in the short term. Brand image has shifted too. In J.D. Power's July 2025 survey on post-tariff confidence, Toyota Lexus ranked number 1 with 52% of buyers calling it the safest bet. Ford landed at 18th, Chevrolet 20th, Jeep 13th. Parts availability plays a big role. Detroit automakers now hold 65 days of parts inventory. Toyota? Just 45. That means faster repairs, fewer delays, and higher satisfaction. Looking ahead, the Detroit Three are split on strategy. One option is to ask Congress for direct subsidies to offset battery production costs. But the House Budget Committee may block that, worried it will fuel inflation. The other option is to optimize North American production under NAFTA Plus. General Motors is ramping up operations in Mexico and Ontario. But Trump's threat of a 15% Mexico tariff looms large. Toyota, on the other hand, has pivoted its Mexican plants to focus on parts distribution, lowering customs risk. Investors took note. Toyota stock hit $160 in June 2025. Detroit automakers? Down 5 to 8% year to date. Market caps paint a stark picture. Toyota is worth $315 billion globally. The combined Detroit 3, $160 billion. Even Toyota's Turkey-Europe-Africa corridor has become a key pressure valve. Its hybrid hub in Sakarya and engine plant in Poland allow duty-free access to the European Union, something Detroit brands can't match due to disconnected plants across Germany, Spain, and Italy. Toyota Global CEO Koji Sato calls it a multi-layered strategy, and it's working. By using local-to-local horizontal networks, Toyota neutralizes regional tariffs. Bottom line, Trump's tariff wall hasn't hurt Toyota, it's supercharged it. If the administration activates a 50% domestic content rule, Toyota's Kentucky and Texas plants will become even more valuable. Hyundai and Kia still haven't localized their Tennessee and Georgia operations at that level. Detroit's issue is clear. Without higher localization, they're stuck in a tax trap. Toyota already builds more in America than they do. So what happens next? Toyota is winning the tariff war. American-branded sedans carry tax baggage. Japanese-branded SUVs roll clean off Texas lots. If Washington wants to change this, it has two options. Rewrite the rulebook with an EU-style carbon and domestic content framework, or scrap the tariff system entirely. Otherwise, the old playbook gets flipped. Toyota might become the dominant force in the U.S. auto industry under the very protectionist policies designed to slow it down. Let us know your thoughts in the comments. And don't forget to like, subscribe, and hit the bell for more deep dives like this. Thanks for watching.